We are in a sweet spot in our economy. 2023 defied a recession with an unexpectedly strong 2.5% real GDP growth rate. According to GDPNow's latest estimate for quarter one of 2024, this strong economic growth will continue. In fact, on February 1st, they just published an estimated GDP growth rate of 4.2%. This is up from 3% just on January 26th. Strong construction spending, new orders, and business reinvestments gave the metric a lift. But when I look out further, that strength is supported. The United States manufacturing sector is on the cusp of a recovery, with January's manufacturing ISM data the strongest it's been since October 2022. Production data at factories have improved. New orders are picking up. Goods inflation is stirring after months of deflation, and supplier deliveries are getting faster. Worker productivity also rose rapidly, advancing 3.3% in the fourth quarter. And this is after a frothy 4.9% surge in the third quarter 2023. This is a sign that the economy could grow faster than expected. Higher productivity is the secret sauce for an economy. When it rises, businesses earn bigger profits and workers reap bigger wages. Higher productivity also helps to reduce inflation. Not only is productivity strong, but so are jobs across all industries. January's BLS jobs report blew away forecasts, with a strong 353,000 new jobs created. That's double expectations. The unemployment rate held at 3.7% against the estimate of 3.8%. And wages doubled expectations, increasing 0.6% month over month, raising the annual wage growth to a 4.5%. This just reaffirms the jobs market is entering 2024 on solid ground. And then there's consumer spending, which remains surprisingly strong despite high costs, high interest rates, and depleting savings accounts. Core retail sales hit a record high in 2023, and Amazon just published their fourth quarter revenue report showing a 14% jump. Consumer spending is 2/3 of our nation's gross domestic product. Given consumer sentiment has climbed a cumulative 29% over the past 2 months, like the largest increase since 1991, it would not be a surprise if strong spending continued. And why not spend when you're feeling wealthy? And the Dow Jones Industrial Average and the S&P 500 continue to push further into record territory, with 68% of all companies beating their earnings forecasts in the fourth quarter of 2023. Now, don't get me wrong, the lack of savings and the speed of spending is a great concern. But an overall strong economic comeback, increasing wages, and decreasing inflation all support a soft landing at this time, as well as an additional delay in rate cuts in 2024. This will cause some market participants to recalibrate their thinking. We're already seeing this as I work up this narrative. While the 10-year Treasury yield touched a 6-month low earlier in the week due to concerns over the regional banking sector, hitting drama that we last saw in March of 2023, the strong BLS jobs report reversed that, sending the 10-year back up above 4%. So what about housing? Denver Metro's real estate market kicked off 2024 feeling just as good about things as the rest of the economy. Buyer demand picked up with mortgage purchase applications jumping 24%, while rates fell into a 5-week 6.6% mortgage rate lull. The end of January saw some turbulence picking up with a strong fourth quarter GDP report, as well as bank concerns and a much stronger than expected jobs report. Due to this volatility in rates, mortgage purchase applications dropped 11% week over week on the last Wednesday of the month. But the last minute swing did not disturb a strong start to pending sales. Pendings jumped 43% from December and 6.5% year over year. And we're seeing 2024 started off with a strong 5% gain in median home prices from January of 2023 and 3% from just last month. While sales volume and closed units were both down, this is more of an indicator of less buyer activity in December than January. The real estate number that I'm most excited about, though, is the 90% jump in new listings from December and 15% jump over January 2023. As buyers get used to 6.6% interest rates, so will sellers decide that pausing life to hold on to a low interest rate is no longer tolerable. While I do not expect the real estate market to parallel the stock market's exuberance, I do expect our market to be better than 2023, to continue to grow as inflation concerns fade and the economy readjusts. What I no longer expect is a Fed rate drop in the first half of 2024. Fed Chair Powell's comments at his January meeting were clear. Housing is not his concern. When asked about lower rates to make housing more affordable, his response was, "Our job, the job Congress has given us, is price stability and maximum employment. Price stability is vitally important, especially at lower income levels. And the tool we have been given to manage inflation is interest rates." Powell wants to see a 2% core PCE inflation over 12 months' time, not the 3 to 6 months that have already hit his metric. Given affordability is unlikely to change meaningfully in the next several months, I would tell buyers that trying to time the market around mortgage rates is a stressful venture. Instead, buyers need to recognize their own personal and financial circumstances. What matters most is whether buying a home meets their needs long term and whether they can afford it. Timing the market was a game for 2021, and that golden window of record low rates has closed. Well, that's a wrap. Cheers until next time. This is Nicole Ruth with the Ruth team. It's my pleasure to keep you updated.